Welcome to the Deep Dive. We cut through the noise, getting you straight to the core insights from the sources you need to understand. Have you ever, had that heart-pounding moment, rushing your cat or dog to the vet, fretting about their health, or maybe you've just paused, thinking about where the food on your plate actually comes from, that whole journey? Well, behind both these, really personal moments and these huge global systems, there's this massive, often invisible industry, animal health. Today, we're diving deep into the absolute global leader in this space, Zoetis Inc. Ticker is ZTS. Now, this isn't just some company. Its influence, it really touches our closest animal friends, and it underpins the entire global food supply chain. It's kind of fundamental. So, our mission for you today, it's simple. We want to give you a real shortcut. We want you to walk away understanding this fascinating, really defensive, and consistently growing market. What's their, secret weapon? That hidden edge that links their success to our love for pets and the world's need for food. We've waded through a ton of material for this one. An in-depth investment analysis, Zoetis' own 2024 annual reports, their quarterly earnings stuff from Q1 and Q2 2025, plus market research, news releases, the works. This isn't just giving the service. It's a proper exploration of the data, trying to pull out those really surprising facts and the key drivers that make Zoetis so unique, so enduring, and what it all means for animal care overall.
Yeah, it's actually amazing how a company so, foundational to so much of our lives can kind of fly under the radar for many people. So today, we'll connect those dots. We'll go from their core strategy, their business model, right through to their financials, their future plans, making sure you understand not just what they do, but really why it matters on a global scale. And we'll definitely unpack that secret weapon, that resilience factor.
Okay, let's kick things off then, setting the stage. What really makes Zoetis this, premier global player in animal health? The core investment thesis paints a pretty compelling picture, right? Mm-hmm. Company perfectly positioned for long-term growth. The analysis says Zoetis capitalizes on these durable secular growth trends, both in pets and in livestock. Now, when we say durable and secular growth, are we basically saying Zoetis is riding a wave that just, can't be stopped, not like some tech fad that just fizzles out? What makes these trends so solid?
That's a great way to put it, actually. Yeah. Think of it less like a temporary trend and more like a fundamental societal shift, like the permanent move to digital payments. But this is for pet care or the basic reality of a growing world population that needs feeding. It's that fundamental. Durable means these trends are tough, they're persistent. They don't just get derailed by, say, a short economic downturn. And secular means they're these long-term overarching trends that kind of transcend the normal ups and downs of the economy. They're driven by these deep societal changes unfolding over decades. So for Zoetis, their growth isn't just a flash in the pan. It's baked into how we live with animals and how we feed ourselves. And this isn't just, hopeful thinking. The company's competitive edge, the analysis really highlights this, it's formidable. Built on 4 pillars. You've got superior innovation, a really diverse product portfolio, unmatched global scale in their operations, and crucially, very disciplined capital allocation, how they spend their money. These things all work together, creating this powerful engine for growth and, staying number one.
That makes a lot of sense. So an industry that's just inherently robust, you mentioned it's a defensive, non-discretionary market. Could you unpack that a bit? Why is animal health spending like that even when times get tough?
Absolutely. Let's connect that to the bigger picture. Animal health spending is largely seen as defensive and non-discretionary. Why? Well, for pet owners, look, their animals are family. That bond, that emotional connection means spending on their health often comes first, even when budgets get tight. People rarely cut back on their kids' health, right? And increasingly, they won't on their pets' health either. It's that emotional drive creating really consistent spending. For livestock producers, it's different, but just as critical. It's about the food supply. It's about their economic survival, preventing disease, keeping animals healthy. It's directly tied to their livelihood and meeting that global demand for protein. A sick herd. That's an economic disaster waiting to happen. So this resilience, driven by both emotion and economic necessity, that's a huge differentiator for this whole industry. And this leads us right into those powerful long-term tailwinds pushing the market forward. We're seeing this huge humanization of pets, our dogs, cats, whatever. They're becoming integral family members. This cultural shift means people are just more willing to spend on advanced care, preventative stuff, treatments for chronic conditions, arthritis, allergies. I heard a stat recently, kind of blew my mind. In some places, pet owners are spending more on their pet's health care than their own dental care.
Wow. Yeah. That says it all about the emotional driver, right? Yeah. And at the same time, you've got this relentless growing global demand for animal protein, population growth, rising middle class in emerging markets. As people can afford better food,
they often choose more protein. So both of these massive global trends are huge for Zoetis. They give them this stable, expanding market for, well, decades to come.
So we're talking about a company really embedded in these deep, long-lasting societal shifts, not just riding short-term trends. That's incredibly powerful. It really gets to why they're so resilient. Let's really unpack the core merits that define Zoetis' top spot, because it sounds like they're nailing it across the board. They really are. First off, just their sheer market leadership in this defensive growth industry. Zoetis isn't just in the market, it leads it. Top market share globally. And they benefit directly from that non-discretionary spending we talked about and those huge secular tailwinds. This consistently drives above GDP growth, meaning, yeah, they grow faster than the overall economy pretty much every year. That's not just good, that's exceptional, consistently. And a massive part of that leadership is their superior innovation and R&D. Zoetis has this proven, really distinguished track record. They don't just make products, they create blockbuster products, things that genuinely create new markets and establish new standards of care. These aren't small tweaks, they're often paradigm shifts. Look at their dermatology franchise, Apoquel, Cytopoint. Before them, treating chronic allergic itch in dogs was frankly a nightmare for vets and owners. Often meant long-term steroids, nasty side effects. Zoetis basically revolutionized that. They created and now lead a multi-billion-dollar market by offering targeted, effective relief. It changed dogs' lives.
And those aren't just isolated hits, are they? We see it too with their parasiticide range, like Simparica Trio, that triple combo simplifies protection. And then there's that really novel monoclonal antibody platform for osteoarthritis or OA, pain, Librela for dogs, Silencia for cats. Those sound like real game changers, redefining how vets treat really common debilitating conditions.
Exactly. Transformative innovations. Not just for the animals, but for the owners and vets too. Beyond that, Zoetis keeps this deeply diversified and durable portfolio. They are definitely not putting all their eggs in one basket. There's a strategic balance across species pets like dogs, cats, horses, and a whole range of livestock: cattle, pigs, poultry, even fish. They also have a pretty even split geographically, the huge U.S. market and the fast-growing international markets, plus a broad range of product types: vaccines, parasiticides, dermatology, anti-infectives. This diversification is crucial. It acts as a hedge against risk, making their revenues much more stable and predictable year after year.
That makes total sense. Spreading risk across animals and countries seems like smart business. But, for a company so focused on innovation, could being too diversified maybe dilute their focus or even slow down bringing breakthroughs to market. Is there a downside?
That's a fair point, and it's always a balancing act for any big company, right? But for Zoetis, the diversification seems to be a net strength mainly because of their scale and those underlying market drivers we discussed. They're not just randomly scattering products everywhere. Their R&D is actually highly targeted, and they leverage shared scientific platforms across species. So, for instance, a breakthrough in monoclonal antibody tech for dogs might directly inform development for cats or even other species down the line. This cross-pollination can actually speed up innovation sometimes. And their global reach means they can launch products regionally, maybe getting approval in Europe first while the U.S. process continues. This spreads out the R&D cost and de-risks individual product launches. It makes the whole pipeline more robust.
And all of that naturally feeds into an exceptional financial profile. We're not just talking okay numbers. The analysis points to consistent above-market revenue growth, and high returns on invested capital. How does this financial muscle actually fuel their growth and keep them ahead?
It creates this really powerful virtuous cycle, a genuine flywheel effect, as the analysts call it. Their financial strength isn't just for show, it's critical fuel. High profits mean more cash, right? That cash then gets smartly reinvested into R&D for the next generation of blockbusters, into expanding their global manufacturing footprint, into strengthening their sales teams out in field. These investments then lead to more innovative, high-margin products, which generate even more cash flow. See the loop. It's self-reinforcing. It drives that long-term value creation. It funds growth, keeps the balance sheet strong, and allows them to return cash to shareholders, too.
Okay, that really helps frame their market position and financial engine. Now let's zoom in. How do they actually translate that mission, nurture their world and humankind by advancing care for animals into, day-to-day operations?
their business model, the different segments, their global reach. How does it all work on the ground?
Right. It translates into this really comprehensive science-first approach. It covers the whole chain, discovering, developing, manufacturing, and then selling this diverse portfolio of medicines, vaccines, diagnostics, technologies. And they do this in over 100 countries. That gives them incredible reach and market intelligence, unparalleled, really. To get a handle on this big operation, we can break it down into two main segments and then look at those by geography, too. So let's start with the companion animal versus livestock split. The companion animal segment, that's their biggest and importantly, their fastest growing division. It brought in about 68% of their total revenue in 2024. Huge slice. This targets vets and ultimately pet owners. Products for dogs, cats, horses. The main driver here, as we've said, is that powerful pet humanization trend. Pets seen as family means people are just much more willing to spend on advanced care, preventative stuff, therapies for chronic issues. Makes this segment incredibly resilient to economic bumps. People cut back elsewhere first. Just to put some numbers on it, fiscal year 2024, U.S. companion animal revenue hit like $5.1 billion. International added another $1.8 billion. And just looking at Q1 2025, the whole companion animal segment grew a very strong 9% operationally, organically across the globe.
That's a massive chunk of the business, clearly fueled by our emotional connection to pets and growing fast. So what about the livestock side? Essential for the food supply, but I guess the dynamics are totally different. Less emotion, maybe more about efficiency, global demand.
Exactly. The dynamics are quite distinct. Livestock was about 32% of 2024 revenue. Here, the audience is farmers, producers, vets dealing with cattle, swine, poultry, fish, sheep. The growth drivers are different, yeah. Fundamentally linked to rising global demand for animal protein, driven by more people on the planet and a growing middle class in emerging markets eating more meat, milk, eggs. Beyond that, there's the critical need for food safety, biosecurity, preventing those devastating disease outbreaks in large herds or flocks, and the constant drive for more efficiency and sustainability in farming. All that requires advanced animal health solutions, vaccines, diagnostics, treatments. Looking at the numbers again, FY 2024, U.S. livestock was $1.16 billion. International was bigger at $1.92 billion. In Q1 2025, total livestock grew 7% organically, operationally. That was mostly driven by really strong 12% growth internationally, even though the U.S. dipped slightly, about 2%, mainly due to some tough cycles in beef and dairy cattle markets then.
So Zoetis is literally serving both our pets and our plates. But what does this mean for their global footprint? How are they structured geographically, and how does that diversity help their resilience?
Yeah, that geographic diversification is key to their stability. The United States is their single biggest market, no surprise, about 55% of total revenue in 2024. It's mature, but still grows consistently. Delivered a solid 6% organic operational growth in Q1 2025, which was about $1.2 billion for the quarter. But the international markets, that's a really critical growth engine, 45% of total revenue in 2024, and it showed really strong momentum recently, an impressive 11% organic operational growth in Q1 2025, generating $1 billion. They've seen particularly strong growth and penetration in places like Brazil, Australia, China, the UK, places where rising incomes are boosting both pet ownership and protein consumption. Now, if you look at the strategic implications of all this, the bigger size and faster growth of the companion animal side is steadily transforming Zoetis' overall business profile. That's a key point from the analysis. This shift towards higher margin, more predictable, less cyclical businesses profoundly impacts its valuation. It makes the company inherently more resilient, more consistently profitable. And this structural shift helps justify that premium valuation. Zoetis gets compared to peers who might be more heavily weighted towards the more volatile livestock sector. Investors really value that quality and predictability. #3, the product powerhouse and operational edge.
Okay, this is where it gets really interesting for me. Zoetis isn't just big. They lead in specific, often game-changing product areas. It's not just market share. It's like market creation, seeing a need, and building something totally new. Let's dive into that product portfolio. What makes it tick?
Right. The strength of Zoetis really comes from the breadth and depth of its portfolio. It's cleverly diversified across many therapy areas, but it's anchored by these massive market-leading blockbuster franchises. That diversity means they're not, overly exposed if one area faces pressure. Looking at the full year 2024 revenue breakdown, it's remarkably spread out. Parasiticides, nearly a quarter. Vaccines, about 20%. Dermatology, 18%. Anti-infectives, 12%. Pain and sedation, 9%, other pharma, 7%, diagnostics, 4%. That's a really healthy, balanced mix. But the real kicker, the wow factor, is those blockbusters. Zoetis has an incredible 14 product lines doing over $100 million in sales each year. That represents more than a third of all blockbusters in the entire animal health industry. That concentration of high-impact winners is quite something. It speaks volumes about their R&D success. Let's look at some headliners. The dermatology franchise, Apoquel Cytopoint, has been a transformative growth driver, seriously. Before these, allergic itch in dogs, a chronic nightmare, often managed with steroids, side effects. Zoetis basically created and now leads a multi-billion-dollar market for targeted, effective relief. Huge improvement in quality of life for millions of dogs. And that franchise kept rolling with 10% operational growth in Q1 2025. Then there's parasiticides, led by Simparica Trio. That's their innovative triple combo, chewable for fleas, ticks, heartworm, all in one. Market leader in a super competitive space, grew an impressive 19% operationally in Q1 2025, still gaining share with a smart omni-channel approach reaching vets and owners.
These aren't just good products. They're solving major, persistent headaches for owners and vets. And then that osteoarthritis, OA, pain franchise, Liberal for dogs, Solensia for cats. That really does sound like the cutting edge. When you say monoclonal antibodies for pain, that sounds like stuff from cutting-edge human medicine. For those of us not deep in the science, what makes these so revolutionary compared to, say, traditional pet painkillers?
You're absolutely right. It is cutting edge, and it is straight out of advanced human medicine, adapted for animals. Think of traditional painkillers like NSAIDs, maybe like a broad-spectrum spray. They reduce inflammation generally, which helps, but they hit the whole system, which can lead to side effects, right? Stomach issues, kidney stuff. Monoclonal antibodies, they're more like a laser-guided missile. They specifically target and neutralize the exact nerve growth factors that drive OA pain. So you get highly targeted relief, often with far fewer systemic side effects. It's genuinely a paradigm shift in managing chronic pain in pets, establishing a new standard of care. Now, it has faced some challenges ramping up in the U.S. We should definitely talk about that later, but globally, the franchise still grew a strong 15% operationally in Q1 2025, shows the underlying demand for something this groundbreaking. These examples really show Zoetis isn't just playing the game, they're often changing the rules, creating the market.
You've highlighted these blockbusters, and they sound truly impressive. But is there a risk for Zoetis in relying too heavily on a few of these game changers? What happens if a competitor comes up with something similar, or maybe regulatory issues pop up for one of these key franchises? Does that keep the management team up at night?
That's a very astute point. And yeah, it's absolutely a risk management focus for any pharma company, animal or human. While Zoetis does have these amazing blockbusters, the key is their continuous, really robust R&D pipeline. They are definitely not resting on their laurels. They're constantly working on the next big thing, but also smartly expanding the labels and uses for their existing blockbusters. That's called life cycle management. It extends the product's profitable life. So while, yeah, a single product might face competition or regulatory headwinds eventually, the breadth of their pipeline in this life cycle strategy is designed to constantly replace and grow revenue streams over time. It's less about relying on just a few products forever, and more about ensuring a consistent flow of innovation that cushions the blow if one product starts to decline.
That makes perfect sense. It's about the engine, not just the current fuel. Okay, beyond the products, what's the secret sauce behind this consistent success? Sounds like there's more to it, like a world-class operational setup maybe. Something beyond just great R&D and marketing.
Indeed, there is. Underpinning all this product's success is their operational backbone. This gives them huge scale advantages and, critically, a really deep connection to their customers. Zoetis runs this expansive global network, 28 manufacturing sites around the world. This huge footprint ensures a resilient and efficient supply chain. It lets them localize production for specific regional needs and regulations. And crucially, it represents a significant capital barrier to potential competitors. It is incredibly expensive and complex to build and run a network like that, meeting all the quality standards. And they keep investing in it. Recent examples include buying a manufacturing facility in Melbourne, Australia, expanding their big distribution center in Lee Summit, Missouri, all about boosting capacity and efficiency. But a key and often underappreciated component of Zoetis' competitive moat, arguably a big part of their secret weapon, is its customer-facing commercial model, their sales force. They have this massive field force, about 300 to 800 people, who are directly engaging with vets and livestock producers every single day. Face-to-face, building relationships, the power of this direct model. It's immense. It fosters deep, trusted relationships. It provides invaluable feedback market intelligence that feeds right back into R&D, What are vets seeing? What do they need? And critically, it enables the successful launch of complex, premium-priced innovations that require significant clinical education and support, like those monoclonal antibodies we talked about.
Yeah, I can totally see how that direct hands-on approach makes a massive difference, especially for those really cutting-edge therapies where vets need to truly understand them before they'll prescribe them. It feels like competitors who rely on third-party distributors would find it prohibitively expensive to replicate that level of direct engagement and educational backup. Am I wrong thinking that direct sales force is one of the hardest things for a new company to copy?
No, you're absolutely right. It's one of the highest, most durable barriers to entry they have. Replicating that kind of widespread, deep-seated relationship building, that clinical education capability, it's incredibly costly and takes years, decades even. Imagine a new company trying to build a 3,800-person specialized field force from scratch, hiring, training, building trust that Zoetis has cultivated over years and years. It's almost impossible without massive long-term investment. And just to underline how important it is, think about the challenges Zoetis themselves faced getting Librela adopted quickly in the US, even with this amazing entrenched field force. It just highlights the immense difficulty any new player would face without such a deeply established commercial presence. The sales infrastructure is way more than just a sales channel. It's a true strategic asset that de-risks and monetizes the company's R&D pipeline. It's fundamental to getting their science to the animals and a huge part of their competitive advantage. Hashtag TouchTech4Pill. Industry dynamics and the strength of the moat.
Okay, so we have a really clear picture now of Zoetis' internal strengths, the innovation, the operational machine. But like you said, no company lives in a bubble. What does the broader animal health industry actually look like? And how does Zoetis keep its top spot in what sounds like a really dynamic, attractive market?
Yeah, this context is crucial for understanding their sustained success. The global animal health market itself is a substantial and consistently growing industry. Projections are pretty healthy. One analysis suggests it could grow from around $63.4 billion in 2023 to maybe as much as $128 billion by 2032. That's over an 8% compound annual growth rate, CAGR. Other reports are a bit more conservative, maybe closer to 6.3% CAGR, hitting nearly $98 billion by 2032. But the key takeaway, whichever number you pick, is that this growth is not tied to cyclical economic trends. It's driven by those powerful, long-term secular factors we talked about, things that just aren't going away. For companion animal drivers, it's all about that deep humanization of pets. Owners treating pets like family means higher spending, less discretionary spending, more preventative care, advanced diagnostics, sophisticated treatments for chronic stuff like OA, allergies. Plus, the global pet population keeps steadily increasing and creates this virtuous cycle for market growth. On the livestock driver side, growth is tied to those big global macro trends, rising population, expanding middle class, driving demand for protein, meat, milk, eggs. And there's also that growing focus globally on food safety, biosecurity, sustainable farming, all requiring more vaccines, diagnostics, other advanced animal health products. So yeah, whether you're a pet owner or concerned about food security, Zoetis sits right at the intersection of these fundamental trends.
Given that attractive growth, it must be a competitive space. Who else is playing here? How do they stack up against Zoetis? Are there other big players trying to grab a piece of this pie, and what makes them different?
Oh, absolutely. It's an attractive market, so it draws competition. The global animal health market, while growing, is actually pretty concentrated at the top. You've got 4 major multinational players. But, and this is important, their strategic focus and business mix differ significantly. They're not all doing the same thing. You've got Zoetis, ZTS, the clear leader, over $9.2 billion revenue in FY 2024. Innovation first, heavily weighted to that high growth, high margin companion animal side, about 75% of their revenue now. Then there's Boehringer Ingelheim. They're private, so numbers are harder to pin down, but they're a huge competitor. Their animal health unit had substantial sales driven by a strong parasiticide portfolio, including the well-known NexGard brand, very strong presence. Merck Animal Health, that's a division of the big pharma company Merck & Co. They did nearly $5.9 billion in revenue in FY 2024. The portfolio is maybe a bit more traditional, with a greater emphasis on livestock that was about 59% of their revenue. And finally, Elanco Animal Health, Elan. They're the second largest independent public player, over $4.4 billion revenue in FY 2024. After their massive acquisition of Bayer's animal health business a few years ago, Elanco's focus right now is heavily on integrating all that, launching new products, and really aggressively paying down the debt they took on for that deal. So the analysis is pretty clear. Zoetis stands out as the innovation-driven leader. They're focused on creating new therapy areas, capturing the highest value parts of the companion animal market. This differentiation really positions it as the premium asset in the industry. We'll see that when we talk valuation.
What's really fascinating is how Zoetis stays ahead.
With all that growth attracting strong competitors, what are the barriers stopping others from catching up? Or stopping new companies from jumping in and grabbing significant share? What really makes up their competitive moat, that secret weapon we mentioned?
That's exactly it, the high and durable barriers to entry. These form Zoetis' strong competitive moat. Let's break them down. First, high R&D costs and scientific risk. Developing new animal medicines is long, expensive, and scientifically risky. It can easily take 10-15 years, hundreds of millions of dollars to bring one new drug to market, and many fail along the way. The sheer time and cost of R&D is consistently cited as the biggest barrier. Second, complex and fragmented regulatory hurdles. Getting products approved is incredibly tough. You need approvals in maybe 100+ countries, each with its own distinct, often difficult requirements. This regulatory maze is a massive hurdle for smaller companies. Third, manufacturing and supply chain scale. Building and running a global, compliant, efficient manufacturing and distribution network. That needs enormous capital investment and deep operational know-how. It's a huge advantage for established players like Zoetis. Then, beyond those, you have brand loyalty and veterinarian relationships. Especially for prescription products, the vet is the key decision maker. Trust, established relationships often built over decades, supported by that Zoetis direct sales force, are vital for getting prescriptions written. Vets trust the support, the training, the reliability, and of course, intellectual property. Having strong patents gives market exclusivity for those blockbusters, protects them from generics for a time, allows premium pricing, which in turn funds the next wave of R&D.
That all makes intuitive sense, the usual suspects for pharma moats, right? But here's something that really jumped at me from the sources, and it's almost counterintuitive: the veterinary workforce strain. A shortage of vets sounds like a problem for everyone in the industry. But the analysis suggests it actually strengthens an incumbent like Zoetis. How does that work on the ground for a busy vet who's already stretched thin? That feels like a really surprising insight into their moat.
It absolutely is surprising, but it's a critical factor reinforcing the power of the big players. You're right, there is a recognized shortage of vets, especially in rural areas and for large animals. Often driven by high student debt, the appeal of city-based companion animal practice. So this strained workforce facing huge time and financial pressures is less likely to invest the effort required to evaluate and adopt products from numerous new or unknown companies. They just don't have the bandwidth. They can't afford the time for trial and error with unproven suppliers. Instead, they naturally gravitate toward trusted, full-service partners like Zoetis. Companies that simplify their clinic operations, provide comprehensive support, offer a wide, reliable range of products they already know and trust. Zoetis becomes like a one-stop shop. It reduces the mental load for busy vets, and indirectly, but powerfully, it strengthens the competitive moat of large established players. It's a pragmatic choice by a profession under pressure, and Zoetis definitely benefits from being that go-to trusted partner. Hashtag tag 5, financial excellence and prudent capital allocation.
Okay, let's pivot to the numbers then. A strong business model, amazing products, a deep moat. That should translate into really strong financials, right? So how has Zoetis actually performed financially over time? And what is their approach to capital allocation, how they spend their money? Tell us about their priorities and future direction.
Zoetis has absolutely established a track record of exceptional financial performance, a real standout. Let's look at their historical financials, say from 2014 to 2024. Over that decade, they've shown really consistent, powerful growth. Revenue nearly doubled from $4.8 billion in 2014 up to $9.3 billion in 2024. That's an impressive 8% average annual operational growth rate since their IPO. And that's about 3 percentage points above the industry average growth rate. Remarkable consistency over 10 years. And that top line growth came with superior expanding profitability too. Adjusted net income grew significantly, more than tripling from $790 million in 2014 to $2.7 billion in 2024. We've also seen their gross margin expand from 65% up to nearly 71%, 70.7%. Operating margin, from 21% to a very healthy 34.7% over that decade. This margin expansion is a key hallmark of a high-quality business. Shows operational leverage, shows the benefit of shifting towards those higher-margin pet products, another critical metric. High returns on invested capital, ROIC. They consistently generate impressive returns, recently calculated around 18.5%, 18.46%. Shows incredibly effective use of capital. Beyond that, operating cash flow surged from $716 million to nearly $3 billion, 2.953B. And R&D spending grew too, from $435 million to $686 million, clearly fueling that future innovation pipeline. These aren't just good numbers. They show sustained, smart financial management over a long period.
Those are truly impressive decade-long trends. Consistent growth, profits growing faster than revenue, always a good sign. What about more recently, reflecting current market conditions, any near-term stuff?
Even more recently, Zoetis has kept up that strong financial momentum. Looking at Q2 2025, the company delivered another strong performance, broad-based 8% organic operational revenue growth. That was driven by solid results both in the US, 7% organic growth, and internationally, an impressive 9%. Shows global strength. Their cash flow generation remains really strong and growing, with that nearly $3 billion in net cash from operations in 2024. And their balance sheet looks very robust, too. About $6.5 billion in total unsecured debt in 2024, but a very manageable debt-to-EBITDA ratio of 1.71. That indicates a pretty conservative approach to leverage. They're also proactive managing that debt. Recently refinanced $1.85 billion in senior notes, pushing out maturities, optimizing their capital structure. Very solid footing.
So this consistently strong financial position gives them a lot of flexibility, a lot of firepower. What does it let them do? And how do they decide where to put that money to keep this growth going? How do they make those tough capital allocation choices?
Yeah, that strong financial base underpins a really disciplined and effective capital allocation strategy. It's been a cornerstone of their success. Their stated priorities are clear, and they follow them sequentially. First, grow revenue at or above the market rate. Second, grow adjusted net income faster than revenue. Third, reinvest smartly in the business R&D, business development. And finally, return all excess capital to shareholders. So looking at reinvestment and growth, R&D expense hit $686 million in 2024, about 7.4% of sales. That's the absolute fuel for the company's industry-leading product pipeline, making sure the next blockbusters are coming. They also invested $655 million in CapEx in 2024, significantly boosting their global manufacturing and supply chain capabilities, building for the future. Then shareholder returns. Zoetis has a strong track record here, too. Returned over $2.6 billion in 2024 alone. That's through steadily growing dividends. They just announced $0.50 per share for Q3 2025 and through share repurchases. It all works together. It creates that powerful, self-reinforcing flywheel of value creation we talked about earlier. Think of it. Innovative, high-margin products like Apoquel generate strong, predictable cash flow. That cash doesn't just sit there. It gets reinvested into their highly productive R&D engine, funding research for the next breakthroughs, like Librela. Those new products then generate even more cash flow. See the cycle. It funds future growth, keeps the balance sheet strong, returns capital, driving the compounding of shareholder value over the long haul. It's a beautifully run system. What's also really notable is their approach to M&A, mergers, and acquisitions. They have this disciplined capital allocation, preferring organic R&D and these smaller bolt-on acquisitions. Deals that strategically fit with their internal pipeline or expand their geographic reach in a targeted way. This contrasts sharply with competitors like Elanco, who did that massive transformative Bayer deal. Those huge deals often bring much higher debt and big integration risks. Zoetis' more cautious approach leads to a lower risk growth profile and stronger financial position, which, again, feeds into why the market gives them that premium valuation. Hashtag 6, growth trajectory and future opportunities.
Okay, given this incredible foundation, the innovation, the financials, the moat, where does Zoetis go from here? What are the clear paths for continued growth? And how are they using cutting-edge tech like AI to stay ahead in such a fast-moving industry?
Yeah, Zoetis' future growth looks set to come from a multi-pronged strategy, really leveraging its core strengths and innovation while smartly expanding into new markets, geographies, and adjacent technologies. At its heart is their relentless innovation engine. Management expects, and this is a strong statement, a significant approval in a major market every year for the next several years. That combines truly disruptive new products, clever lifecycle innovations for existing brands, and strategic geographic expansion. It signals a really deep and active pipeline focused on consistently tackling unmet medical needs. What's really impressive now is how they're leveraging advanced technology. Zoetis is proactively integrating advanced technologies to keep that R&D leadership sharp. In 2024, they launched a dedicated automation and data sciences group. Its job, apply artificial intelligence AI to speed up R&D. For example, they're using AI tools to analyze massive biological data sets, identifying potential new drug targets or biomarkers way faster than humans could. They're even using generative AI to get deeper insights into complex conditions like chronic kidney disease in pets. Could really accelerate drug discovery. And in 2025, they're piloting an AI-powered system for managing clinical trial data. The aim is to make reviewing scientific data significantly faster and more accurate. This forward-looking tech adoption is absolutely crucial for staying ahead and keeping that flow of blockbusters coming.
That's fascinating. How exactly does AI speed up R&D in a way that traditional methods can't? Is it finding new drugs or just making old processes faster? Or both?
It's really a combination of both. AI significantly accelerates several key stages. In the discovery phase, AI can analyze like billions of chemical compounds or genetic sequences incredibly quickly, spotting potential drug candidates or disease markers that might have been totally missed otherwise. For existing processes, AI streamlines things like designing clinical trials, maybe optimizing patient selection for animal studies, and analyzing the data that comes out. Instead of scientists spending weeks, maybe months, manually sifting through mountains of data, AI can rapidly highlight the key findings, the anomalies, the patterns. This lets the scientists focus on the science bit, not the data crunching. It can drastically cut the time and cost for both finding new solutions and getting existing ones developed and approved faster. Makes their whole R&D operation far more productive. Now, beyond the brand new stuff in AI, core market expansion is also a key strategy, getting the most value out of their existing portfolio and pushing into new markets. A crucial tactic here is lifecycle innovation, basically expanding the approved uses, the label is the claims, for their existing blockbusters. This extends a product's profitable life and grows its addressable market, but usually at a lower R&D cost than starting from scratch. Good examples: getting Simparica Trio approved in the US and Canada for preventing infestation by that invasive Asian longhorn tick, or getting the chewable version of Opokel approved in the huge, fast-growing Chinese market. Smart moves. Alongside this, geographic expansion into emerging markets, Brazil, China, other parts of Asia-Pacific, Latin America offers substantial long-term growth opportunity. Driven by rising pet ownership and protein consumption, that impressive 11% international organic operational growth in Q1 2025. That's clear proof this strategy is working well. They're also investing beyond their core pharma and vaccines, looking at adjacencies and new frontiers. They're actively growing their diagnostics portfolio. Recent innovations include AI-powered urine sediment analysis, AI-powered blood count analysis for their VetSkin in-clinic diagnostic machines. Now, this is strategically really important. Why? Because by providing the diagnostic tools, Zoetis embeds itself more deeply into the veterinarian's clinical workflow. It creates this very sticky ecosystem, makes it harder for vets to switch away if their diagnostics and their treatments are all integrated on one platform. They're also investing in digital health and precision livestock farming. For instance, collaborating on an AI model for Norwegian salmon farmers to predict disease outbreaks before they happen, allowing for proactive treatment. This shifts them from just selling products to providing these high-value, data-driven services that improve animal health and farmer profits. It's a smart evolution.
And what about acquisitions? You mentioned their disciplined approach earlier. Do acquisitions play a big role in this future growth, or is it mainly driven by their own internal R&D?
Their M&A strategy remains very disciplined and strategic. The focus is clearly on those smaller bolt-on deals. Acquisitions that specifically complement their internal pipeline, maybe fill a small technology gap, or expand their geographic footprint in a very targeted way. This approach keeps their balance sheet strong and, importantly, avoids the huge integration risks that have tripped up some competitors after massive deals. It fits perfectly with their lower-risk, highly profitable growth model. So, yes, M&A is part of the toolkit, but it's definitely supplementary to their powerful organic innovation engine.
Okay, while that growth story is incredibly compelling and their strategy seems really solid, every investment carries risk, right? What are the potential challenges, the headwinds that Zoetis faces, things that you and I, as informed listeners, should maybe keep an eye on? Even the strongest companies have vulnerabilities.
You're absolutely right. No company is bulletproof, and Zoetis operates in a complex world with risks. We can group them into a few areas. Let's start with key franchise threats. We are definitely seeing intensifying competitive pressure across their key growth drivers: Simparica and parasiticides, their dermatology franchise, the new OA pain franchise. Pressure comes from established peers launching rival products and sometimes new entrants too. While Zoetis holds its leadership, this competition could potentially impact future market share and pricing power over time, especially in crowded markets like flea and tick control.
How serious is this pressure? Is there a real risk of one of their blockbusters suddenly becoming obsolete because a competitor leaps ahead? Or is it more like gradual, incremental market share erosion?
Typically, it's more about that incremental market share shift and pricing pressure, rather than sudden obsolescence. Given the strength of Zoetis' R&D and their continuous lifecycle work, they usually stay ahead or alongside major new threats. But even small share shifts can be significant when you're talking about products doing billions in revenue. The key is these are highly attractive, growing markets, so naturally they draw strong competition. Zoetis' strategy is always to out-innovate and out-execute, but yeah, the pressure is constant. A very specific near-term headwind is those OA pain adoption challenges, particularly with Librela in the crucial U.S. market. The uptake has been slower than expected, especially compared to how fast it took off in Europe. Management points to the significant market development needed educating vets about this totally new type of therapy, a monoclonal antibody for pain. It's a shift in practice. They've also had to deal with some social media headwinds about perceived safety concerns, which apparently impacted new patient starts, even though clinical trials show a strong safety profile. This really highlights the significant execution risk involved with launching truly novel, first-in-class therapies, and it could negatively impact investor sentiment if it drags on. It shows a potential vulnerability. Scientific brilliance and a great sales force don't always guarantee instant commercial success, especially with something brand new.
That makes perfect sense. Launching a totally new treatment type, especially one needing vets to change habits, is never easy. And social media can definitely amplify concerns, whether they're fully justified or not. What about broader economic or operational pressures that could hit Zoetis?
Absolutely. From a macroeconomic and operational view, they're navigating supply chain and inflation like everyone else.
Yep.
Management mentioned higher manufacturing costs were flowing through their inventory in the first half of 2025, a lingering effect of prior inflation, although they expect it to ease. And the sheer complexity of their global manufacturing network means supply chain disruptions from natural disasters, geopolitical issues, whatever, remain a key risk they have to manage constantly. Now, while the animal health market is famously resilient, a severe and prolonged economic downturn could still pressure household budgets. It might lead some pet owners to delay non-essential vet visits or maybe seek lower-cost generic alternatives for some things. Management has acknowledged this uncertain macro environment. Also, being a truly global company, Zoetis is exposed to tariffs and foreign exchange volatility. With 45% of revenue coming from outside the U.S., swings in currency rates can negatively impact reported financial results. A strong U.S. dollar, for instance, makes those international sales look smaller when translated back. And finally, there are regulatory and long-term risks. There's growing global concern about antimicrobial resistance. This could eventually lead to further restrictions on the use of anti-infective products, especially in food animals. That impacts a significant category for their livestock business, pushing them to innovate more non-antibiotic solutions. Like all drug companies, they face the fundamental long-term risk of patent expirations. Eventually, patents run out, generics arrive, prices and volumes erode. That continuous R&D productivity is absolutely vital to replace revenue from drugs losing exclusivity. And, of course, manufacturing and quality control are absolutely paramount. Any failures, contaminations, recalls could lead to significant financial penalties, litigation, and critically damage to the trust in the Zoetis brand. That trust, built on safety and efficacy, is invaluable. These are inherent risks in running a business like this at their scale. #8. The premium valuation explained.
Okay, let's try and tie all these insights together now from an investment perspective. The analysis consistently highlights that Zoetis trades at a significant premium. Its stock price is high relative to earnings, compared to peers, compared to the market. What's the context for this? And maybe the million-dollar question. So is that premium valuation actually justified? Or is it just, market enthusiasm running a bit hot?
Yeah, this is a critical point and one that always generates debate. Looking at its historical valuation perspective, Zoetis has pretty much always commanded a high price to earnings, or PE ratio, since it went public. Over the last 10 years, its average PE has been around 39.4x. It even peaked way over 70x back in late 2015 and hit 57x in 2021 during that growth stock frenzy. As of September 2025, the PE is about 26.1x. Now, that's notably below its long-term historical average, which might suggest some normalization after those really high peaks. Looking at enterprise value to EBITDA, another key metric, it's been in the range of 18.1x to 18.8x on a last 12 months basis. Still pretty robust. Now, when we do a tier group valuation analysis, LTM, that premium really jumps out. Zoetis' PE around 26.1x, EBITDA 18.1x, price to sales 6.9x. Compare that to Merck & Co. MRK, remembering it's the parent, not pure animal health, PE 13.0x, EBITDA between 8.2 by 15.3x, PS only 2.0x. So yeah, Zoetis trades at a substantial premium across all the key multiples compared to its direct peers in the broader healthcare sector. No question about it.
That's a really stark difference. The market is clearly valuing Zoetis very differently. So what's the fundamental justification? What connects this high valuation back to the actual business quality we've been discussing, rather than just market sentiment?
Right. The premium is not without justification, and it's directly linked to the company's superior business quality and financial metrics that we've talked through. Let's recap why. First, superior profitability. Zoetis' LTM EBITDA margin is around 43%. That is more than double Elanco's, which is closer to 20.5%. That shows a significantly more profitable, efficient business model. Second, higher returns on capital. Zoetis' return on equity, ROE, is 52.1%. Return on invested capital, ROIC, 18.5%. These are dramatically higher than Elanco's numbers. Shows far more effective use of capital to generate profits. Third, that higher quality business mix. With about 75% of revenue now coming from the faster growing, higher margin, and more resilient companion animal market, that segment inherently commands higher multiples because it's seen as more predictable and defensive. And finally, a stronger balance sheet. Lower leverage gives them more financial flexibility for future investments, acquisitions, or shareholder returns. So you put all those factors together, higher profitability, better returns, better business mix, stronger balance sheet, and they fundamentally support why the market awards Zoetis that premium. It truly is seen as the premium asset in a defensive, growing sector.
That makes sense. But it raises the next question: what could actually change this valuation? What could push it down or maybe even higher in the future? What are the key catalysts that an informed listener like you should really be watching?
Good question. The primary catalysts for multiple contraction, meaning the valuation premium shrinks, would likely include a failure to meet commercial expectations for a key pipeline product. For example, if that U.S. launch of Librela continues to significantly underperform for a long time, that could shake confidence. Also, significant or sustained market share loss in their core franchise's dermatology, parasiticides to new competitors would hurt, or just a broader market derating of high-quality growth stocks due to macro factors, like persistently high inflation or interest rates making investors more risk-averse. Conversely, catalysts for multiple expansion, the premium growing or being strongly reaffirmed, could come from a major positive surprise from the R&D pipeline, maybe a new blockbuster in a totally new area that the market wasn't expecting. Accelerated adoption of the OA pain franchise, if Librela finally hits its stride globally, could also boost sentiment, or faster than expected growth and margin expansion, particularly in those key emerging markets. So yes, the premium is justified by fundamentals today, but it's definitely not guaranteed forever. It's constantly being reevaluated based on their execution and innovation.
We have covered a huge amount of ground in this deep dive. Looked at Zoetis from pretty much every angle: strengths, risks, financials, future. Let's try and synthesize this now into some core takeaways, almost like a rapid-fire Q&A, directly hitting the big questions about Zoetis that you, our listener, might still have.
Sounds good. Let's pull it all together. Fire away.
Okay, first big one. How sustainable is Zoetis' competitive advantage in this pretty fragmented animal health market? Is that moat really strong?
The short answer: highly sustainable. It's rooted in this multifaceted and self-reinforcing moat. It's not just one thing. It's their innovation leadership, constantly boosted by AI now. It's their unmatched global commercial scale, especially that direct-to-vet sales force building deep relationships. It's their trusted brand built over decades. And it's that integrated ecosystem, diagnostics, drugs, vaccines, all working together, which increases switching costs for vets. Makes it really hard for them to leave Zoetis.
Got it. Next. What's the long-term growth potential for companion animal versus livestock? Are they equally attractive going forward?
Definitely not equal. Companion animal has significantly higher and of better quality growth potential. It's driven by those powerful, durable, consumer-led trends, pet humanization, more medical spending. That leads to predictable, high-margin, really resilient growth that holds up well in downturns. Livestock offers more modest, maybe GDP-plus growth, tied to global population and protein demand. It's generally more cyclical, lower margin, but it provides crucial scale and diversification for the overall business. Still important, just different dynamics.
Clear distinction. Okay, third, how effective has the company been at reinvesting capital for growth and innovation? Are they actually putting their money to good use?
Exceptionally effective. The proof is in those consistently high returns on invested capital we talked about. Their flywheel business model works. Cash from high-margin products gets smartly reinvested into productive R&D for the next generation. That's the core. And crucially, their disciplined focus on organic growth and those smaller bolt-on acquisitions instead of massive risky M&A like some peers reflects really prudent capital stewardship. It's kept their balance sheet strong.
And a crucial one for many investors, especially now. How resilient is this business model during economic downturns?
Answer: highly resilient. They've shown consistent growth across different economic cycles since going public. Companion animal spending, as we said, is largely non-discretionary for many owners. Pets are family. And livestock is tied to fundamental global food production, also pretty non-discretionary. That combined portfolio gives them a remarkably stable defensive revenue base that tends to outperform in tough times.
Last one. Looking ahead, what's the realistic, addressable market expansion opportunity over the next decade? Where can they still grow, even being the leader?
The opportunity is still substantial. It comes from three main areas, or vectors. One, geographic penetration. Still lots of room to grow their presence in large, fast-growing emerging markets where pet ownership and protein consumption are rising rapidly. Two, increasing the standard of care, driving adoption of more advanced treatments for chronic, age-related diseases. Think about making OA pain treatment with Librela as routine, as widely adopted as flea and tick pills are today. That's a huge potential uplift. And three, creating new markets, using their R&D engine to develop truly first-in-class therapies for conditions that aren't really treated well or at all today. Just like they did with canine dermatology years ago with Epical, they literally created that multi-billion-dollar market. There's still plenty of white space for innovation like that. Hashtag, tag, outtag, out.
And that wraps up our deep dive into Zoetis and the future of animal health. It's truly fascinating, isn't it? Seeing how a company in what might seem like a niche, albeit essential industry, is actually sitting right at the crossroads of so many crucial global trends, from that incredibly personal bond we have with our pets to the absolute fundamental need to feed a growing planet. Zoetis plays this significant, often pioneering role. It really does embody that secret weapon of resilience combined with smart execution.
Yeah, it's a powerful example of what focused innovation and disciplined strategy can achieve in a market that, while definitely robust, certainly isn't simple. It has complexities, real competitive pressures. Understanding a company like Zoetis gives you a window not just into sophisticated business strategy, really into the bigger societal shifts happening all around us and how they all connect.
Absolutely. And as you step away from this deep dive today, maybe consider this thought. As our understanding of animal health, longevity, and welfare keeps advancing so rapidly, driven by companies like Zoetis, increasingly fueled by tech like AI, what are the ethical and societal implications? How does it change how we define care for animals, both our companions and livestock? And how might that evolving definition of care in turn reshape our relationships with animals and maybe even our global food systems over the next 10 years or so? It's a space that's not just about business, it's really about the fabric of our interconnected world. Leaves us with a lot to think about. We hope this deep dive has given you plenty to chew on. Thanks for joining us.